So thank you very much for inviting me over. It's lovely being here. My name is Amit Kumar. My background is in research. So I did my undergrad in India, and then I moved over to Paris, where I did engineering in computer science, and then decided to do PhD in computer science. So my area of expertise was basically around system security and privacy. So I was looking at software systems and trying to understand how those software systems impact people's security and privacy. So imagine, for example, you install a software like, let's say, antivirus. It may scan all the files that you have on your system, and then it may send some of this information back to the backend service provider. So the idea was to be able to understand what sort of privacy and security implications you have when you install and use certain software systems from outside. And then, I moved over to blockchains, and I decided to sort of explore the idea of what scientific problems exist in the blockchain world. And eventually we started to work on this company called Zilliqa, which is a blockchain platform designed to scale. My talk has been structured in a slightly different way than I may not have thought initially. So I felt that presenting Zilliqa as a platform and company, what we do is sometimes might be a little bit less interesting. So what I did was I tried to set up a little bit of context. And so if you go through my slides, which I'm going to present and show you today, is I'll present to you the idea behind what's called a decentralized finance. So it's a new emerging area of services and products that are being built in the blockchain world. And you won't need any expertise and any background in what blockchain does and how blockchains work. But the idea is to be able to give you a sense of what this area of decentralized financial applications means and products means. And that will sort of challenge, give you some ideas on why some of these products and services don't quite work, and what are the challenges that we face today when you actually go and use some of these systems. And then I will put you and take you through what Zilliqa does to try to solve some of those problems. So let me put down my slides. So as I said, we're going to talk about decentralized finance. So you must be familiar with financial applications today. For example, when you go to, and the basic financial application is the payment. So when you go and buy certain products and services today, whether it be Amazon or whether it be your grocery shop, you have to pay. You have to pay using fiat. So that payment method, the currency, is the vital piece to build any financial structure, right? And once you have a payment, you can imagine all sorts of products and services that you can build, whether it be lending, whether it be mortgage, whether it be insurance, whether it be derivative products, and so on. Now, the idea behind decentralized finance is to be able to build all those products and services on a blockchain, okay? But before that, let me try to motivate why people are trying to build some of these applications on the blockchain in the first place. So for those who have seen, who are aware, following the news, let's say last month or so, you would have seen this, immense upside down sort of event happening in the financial market, where the GME, the company, and the stock, the GME stock, there was a whole drama around this. And why? Because there were a group of people sitting on the Reddit community who were trying to challenge what hedge funds and what traditional financial structures and systems were trying to bet against those companies. And what ended up happening was that because the market felt that it was being manipulated, the companies who provide those services for people to buy and sell those stocks basically had to shut down the services. So it's a good example of why the problem that is inherent in certain traditional financial services, because these systems are controlled by centralized parties. So these centralized parties can decide and prevent certain people, depending on their whim, can decide to stop people from accessing those products and services. So the idea behind decentralized finance is to be able to change that upside down, literally. So the basic vision behind decentralized finance is to be able to build products and services that you see today and use today in the traditional financial world, whether it be mortgage, insurance, banks, and so on, in a way that you could actually access them in a borderless manner. So whether you'd be in Nigeria, whether you'd be in India, it doesn't matter where you live and where you work, you can always be able to access those services. And all that you need to be able to access those services is a mobile phone and internet connection. That's the basic thing that you need. And once you have that, you should be able to access those services without any glitches. And that's very powerful, because today, if you go and look at bank accounts and how banks work, it's very possible and quite likely that when you open a bank account, you have to provide your proofs. When you go and borrow a loan, you have to provide credit score and so on. So it becomes very complicated and becomes restrictive in many ways. And if you are from certain countries, it becomes very difficult for you to even get a loan. So the idea is DeFi is literally to take every single financial application that you see and use today in the traditional world and translate them into a version that is unstoppable, the version that's much easier for people to use and get access to. Now, if you look at some of the key features that DeFi applications actually try to aim at, one is borderless. So you have to ensure that these applications can be accessed, can be used from anywhere. So it doesn't matter where you live, where you work, where you are from, your nationality, you should always be able to access those products and services. Number two is that it's unstoppable. So any company, so there's no centralized party who's running that service. So there's no centralized party who's providing that product and service. So it's very difficult for them to stop you from using those services. So it's very difficult for any party, not just the person who's starting that or running that service or providing that service, but anyone. It's very difficult for them to stop you as a user of that system. So that's very powerful, because today it's very easy for a bank to basically freeze your account. It's very easy, literally. Now, the other part is about transparency. So for example, in many cases, especially in for example, the GME stock case, it was very unclear why certain decisions were made to stop the trading on Robinhood, for example. Why users who were trying to trade those stocks were not allowed to do so for a certain period of time. While in the DeFi world, the idea is to be able to make things transparent. So when you are, let's say, using the service, you should know what parameters are being set for the service that you're looking at. And those parameters can be changed only under certain conditions that is well known to everyone. So you know exactly how the system is going to behave if the whole code is correct and so on. You know exactly how the system is going to behave, and you know exactly how certain things are being done, because everything is in a way public and is governed by a blockchain. So no single party can decide to change the rule, depending on when they want to do so. And the last part is the one that's very powerful. That's exactly why DeFi has really literally spread out in all directions, about composability. So today, for example, when you build, so the whole DeFi world works in a Lego way. So you start with a small piece. Let's say you build a payment. Then you can plug that payment with, let's say, a lending service. Once you have a lending service, you can plug, it may need insurance. So you can plug an insurance service behind that, and so on. So you can build all sorts of products and services just by composing with other existing services. This is something that's not so straightforward in the current financial world, because you need there has been a series of work in the traditional financial world where people have been talking about open finance. People have been talking about, you logging into your HSBC account and be able to access your mortgage information. So this is something that people have been trying to do in the traditional world, but it is actually baked in naturally in the DeFi world. So you can easily plug and play different products and services and be able to build more complex products and services. This is exactly why the whole DeFi world is sort of mushrooming around, a few central pieces. Now, of course, I've said this already before. You can imagine that, if you ask me what sort of products and services we could build using DeFi and decentralized financial services and products, it could be all sorts of things. So literally everything that you see today in the traditional world, starting from stablecoins, so the payment method. You can talk about exchanges, so you can issue digital assets. And once you have digital assets, you may want to have a platform, a marketplace where you can trade those assets, again, in a peer-to-peer manner. You could imagine money market funds. So if you want to, for example, let's say if you have excess money, and if you would like to loan it to someone else in exchange for a certain return, you'd be able to do that. You can imagine building peer-to-peer insurance products where certain services and products are being built and being insured by a community. And this insurance product is particularly interesting, is because all the DeFi products that exist today and services that exist today, one of the biggest challenge is around technical, one of the biggest risks around using some of those services is technical risk. So you don't know for sure that the contract or the application that you're using today is safe and secure to use. And therefore, a new type of risk is emerging in this DeFi world, and that risk is technological risk. So the idea is to be able to build products and services that can cater to those specific types of risks. Again, you can imagine all sorts of derivative products. You can imagine, for example, synthetic assets. So there are people in the blockchain world who obviously hate all centralized services and all central governments, but there are also people who would like to have access to commodities. They would like to have access to stocks. They would like to have access to private equities. And one way to do that is it's what's called via synthetic assets. So basically what you do is, let's say you want to get access to and buy gold. Now, in the traditional world, in order to buy gold, let's say a substantial chunk of gold, you'd have to do KYC and so on from the vendor. But in this world, what you would essentially do is create a synthetic asset that is pegged to the value of gold. And when you trade, what you're actually trading is basically a synthetic asset. So you don't actually hold the gold ever. You're only holding a synthetic asset that's pegged to the value of gold. Now imagine again, it can extend to once you have all those assets, you may want to have a way to manage those assets, right? Because today in the traditional world, you have asset managers, you have portfolio managers, you have hedge funds who take investments from people and then manage those funds on behalf of the investors. So the idea would be, sometimes these investors, let's say if I put my money in some of the hedge funds or some of the let's say asset managers, sometimes very unclear to me what sort of decisions they make to make money from my money, right? But in this world, you can actually build sort of decentralized hedge funds that sit on a blockchain and that decide what sort of products and services this hedge fund is going to invest in. So you know exactly where your money is going and how your money is making money. Now, to give you a sense of a concrete sense of what exactly I mean by a product, here's an example of building a stablecoin. Now, the simplest way to build a stablecoin is to say that, look, here's a US dollar or here's a Swiss franc. And what we're going to do is we are going to tokenize them. So we are going to lock, let's say, $100 in a bank account, and we are going to issue 100 tokens. And these tokens basically represent the dollars that we have logged in a bank account. And you can basically trade those tokens as if they were dollars, right? So a user comes in, he puts $1 in the system, in a system, and this $1 goes to a bank account, and then the user gets a stablecoin. The problem with this model is that it's backed by fiat. So it's backed by a system that's centralized, and that's one thing that we don't like in DeFi world. So the idea behind one of the ideas that people and in the DeFi community have been sort of pushing forward is to build a stablecoin that does not rely on any centralized fiat system. And here's an example of how you can build this. So imagine, for example, in order to explain the system, I would like to I imagine two sort of agents in the system. So you have one agent, which is stablecoin user. So he's an agent who basically holds a volatile asset. So it could be Bitcoin, it could be Ethereum, it could be Zilliqa, the tokens for in the Zilliqa chain. It could be any asset that's volatile and that's crypto backed. So it's a crypto asset, and therefore does not rely on any central party. And then you have the second agent, which is the speculator. So he's also holding the volatile asset, but he is sort of looking up from a sort of a volatile angle. So he's expecting that the price of the volatile asset will go up, and therefore he will make money. While the stablecoin user is still holding volatile asset, but he doesn't want to make money. He just want to make sure that he doesn't take a loss. So basically, his position is very market neutral, while the position of a speculator is a speculative position. So he wants to make money. Now, in order to build a stablecoin, because this is what a stablecoin user wants, what you could do is he starts with, let's say, 100 ZILs. So ZIL is the token. You can replace that by BTC or Ethereum, whatever you want, right? It doesn't matter. So imagine that at this point of time, the contract starts to come into place. So the speculator comes in and he says, here's my 100 ZILs, which, assuming that one ZIL is $1, it becomes $100. So he puts that money in a contract. This contract sits on a blockchain. At the same time, stablecoin user comes in and he puts 100 ZIL as well. So again, the total sum that stays in the contract is 200 ZIL, which is $200, assuming that the ZIL price is $1. Again, remember that stablecoin user always wants stable assets in terms of fiat value. So if he has put $100, he wants $100 back. Okay, it doesn't matter how he gets it. He always wants that $100 back. Now, what's going to happen is, imagine a scenario. So this is the setup. This is how the system starts. Now imagine, let's say, after a time. So this is the current status of the contract. So the contract holds $200 worth of ZILs, and each user has put in 100 ZILs. Now, what's going to happen is, after a while, the system is going to detect that the price of ZIL has gone down. So instead of when the contract started, the price of ZIL was $1, but now the price has gone down from $1 to 50 cents. Now, what is the implication of that? Is because the implication is that previously the 200 ZIL that was in the contract valued at $200, now it values at $100 only. Okay. Now, Remember, stablecoin user always wants fiat. I mean, not fiat, but always wants fixed amount of fiat in volatile currency, while the speculators can take the risk. Now, this is the time when the contract ends, so expires. At that point of time, what's going to happen is stablecoin user will be given the entire ZILs, so all the 200 ZILs, which is now valued at $100. So as you see, even though stablecoin user was holding a volatile asset, he's guaranteed that he's getting, a fixed amount of fiat, no matter what happens. Okay. What happens on the speculator side right now is that he's going to take the loss. So now he's going to get 0 ZILs because he's basically covering for all the loss that stablecoin user had to take. Obviously, if the price of ZILs had gone up, let's say from $1 to $2, then the stablecoin user will get, again, fixed amount of fiat value, so $100, but then the amount will be, number of ZILs will be 50 ZILs, while the speculator will make money. So this is a simple way in which you can build a stablecoin without relying on any fiat component, without relying on any central party. The only thing that you need is, and the only thing that you're exploiting in the system is that you're assuming that there are people who are hoping that the price of the underlying asset will go up, and there are people who hold that asset and who don't want that exposure, so who only want market neutral exposure. And just because you have those two sort of system players, you are able to construct a stable coin that works on both sides. So a speculator could make money while stablecoin user always gets the fiat denominated number of ZILs. Now you could always say that, okay, this is the contract that has expiry date. How can I guarantee that my risk is always covered, right? And this is exactly what some solutions have come up. So there's this idea of, I'm not sure if you know this, but there's the project called MakerDAO, which basically builds upon this idea. But then what it does is it removes the fact that the contract has to expire. So basically, again, the system is very simple. You have speculators who are holding a volatile asset, and they're hoping that the price of that asset will go up. So they're basically taking a long position on that asset. And what happens is they take that volatile asset, put that in a contract, and against the collateral that they're putting in the contract, they can mint stable coins. Okay, so for, let's say, for every $500 worth of volatile asset that they put, they can mint $100 worth of stable coin. And what they do with the stable coin is they take those stable coins and then sell it to stablecoin user, because stablecoin user, remember, they want stable coins. So what they will do, these stablecoin users will buy the stablecoin asset from these speculators and will give them the volatile asset. Now, what ended up happening was that now speculator who started with a collateral, now he got more of those assets. So basically, what ended up happening was he created a leverage position on his assets. So if he was long on the underlying asset, now he has some more assets to take care of. So more assets to take benefit of. Obviously, there are systems in which, if the price really goes down, then there will be what's called a liquidation event and make sure that the collateral ratio gets maintained. But basically, the idea is very simple. You assume that you have a speculator, you assume that you have a stablecoin user, and you basically match them by creating a product that fits the needs, meets the needs of both parties. And again, remember, there's no central parties which is being used. Everything is being settled and being handled using a simple contract that sits on the blockchain. Now, to give you a sense of how big, again, there's just an example, but there are all sorts of applications that you can imagine that has already been built using blockchains in the DeFi world. To give you a sense of how big this industry is, the total value logged, so the total number of assets which are actually being used in different DeFi products and services is close to around $40 billion. And it's constantly growing. So the chart on the right kind of shows you how this value logged, which is one metric to measure the activity happening in the DeFi world, it's growing at a rapid rate. But obviously, as you can imagine, the whole world of DeFi is not all rosy. There are always obviously challenges and problems that the DeFi world is facing. And my idea for the next slides would be to give you a sense of what those challenges are. One, because I feel that it's important not to see not just to see that, okay, everything's rosy. We have to understand what the challenges are, but also because this gives us ideas on what we can build. So how we can build the different other products and services that can improve upon the state-of-the-art products and services. So we need to understand the challenges. We need to understand why and what are the things that are not working in the DeFi world. So here's an example. So the first challenge that I feel is about user base. So today, if you look at the Ethereum ecosystem, which is the most, let's say, the biggest ecosystem out there in terms of blockchain, it has around 143 million addresses. So the number of people who actually hold Ether is roughly equivalent to around 143 million. But if you think about how many people who actually hold Ether are actually using any of these DeFi products, the number is very few. So to give you an example of what I mean by this, by very few, on the left-hand side, we have a table that lists the number of users, the number of traders who are trading on different decentralized exchanges. So these are marketplaces where you can buy and sell assets. So the most popular is obviously Uniswap. So the number of people are trading on that Uniswap in 7 days. It's not even a day. So in total over 7 days is around 130K. If you go a little bit down, the number of people actually trading goes down to even, let's say, 100,000 people on a weekly basis, which is very few compared to the number of people who actually hold assets. So it gives you a sense of there are probably 99% of people who hold assets, who hold blockchain assets, but they have never interacted with any single dApp which is out there on the Ethereum ecosystem. And that's a huge thing to understand and sort of think about why people are not using this. Is it because people only think that these assets are volatile and I could only make money, and so I will only take sort of use them or have them or buy them only for speculative reasons, or are they really interested in actually using them? So from the looks of it, it appears that a lot of people are actually not using any of the DeFi products that are being built. So we have to understand why these people are not using them and then build products and services that can cater to those audience in the right way. The second challenge is around scalability. This is a challenge that we see on a regular basis. Now, as I said in my last slide, the number of people who are actually using some of these products is already very few. So it's not that many. And yet we are already seeing the capacity of, we're already seeing that the blockchain, the underlying network, is not able to process that many users. So here's an example of a user trying to sell one asset for another asset, and the amount of value that he wants to transact is $19, but he's asked to pay $21 worth of fees to be able to process that transaction. This is ridiculous because it's no reasonable user would buy certain thing and pay more than that to be able to for that transaction to be processed. It just doesn't make sense. And the reason is because the underlying platform, which is Ethereum in this case, can only process 15 transactions per second. Just to give a sense of how far this is from, let's say, traditional application, Visa, which is always used as a benchmark because it's a payment service provider, and it's a service that everyone uses on a daily basis. The number of transactions that Visa can process is roughly between 5,000 to 8,000 transactions on a regular day. So I'm not even talking about Christmas shopping and stuff, but on a regular day they can process around 5,000 to 8,000 transactions per second. So it clearly shows you that the platform is definitely not able to process the demand that's being imposed by incoming users. And that's a huge challenge to fix. The third challenge is obviously DeFi today, we live in a world where there's a lot of experiments going on. And these experiments, in many cases, are not very responsible in nature. So people and developers build products. These products are sort of thrown into the wild without being well tested, without being well audited. And then people who are involved in the blockchain community, they go and use these products and services, even though they know that these services are not well built, these services are not well tested. And in the end, what ends up happening is that these products and services starts to lock hundreds of millions of dollars worth of assets in a contract that was developed over a weekend. And as you can imagine, then attacks starts to happen. So then bugs start, people start to find bugs, and then people start to attack those contracts. So that's something that I really feel that we as a community in the DeFi world have to fix it. And it's not something that someone else can fix it. We have to be responsible about how to build products and services that people can safely use. And we don't have to be take your time. We have to take time and make sure that the product that you're building is well tested, is well audited, and then only users should be allowed to use those services. And obviously there are all sorts of scams that are happening, but that's something that happens in all spheres. So I'm not going to talk about scams, but I really want to stress the fact that there are developers who have to, and we should, as a developer, have to be careful about what the products and services we build and how these products and services get used by people in a responsible manner. The last part is about capital inefficiency. So for example, the reason why I'm talking about this, because today, again, this comes from the fact that because blockchains are sort of don't require central parties, they don't have a way to, let's say, know and do KYC of users. Let's say, for example, you're using a lending platform. So you go and borrow, let's say, a certain number of, let's say, stablecoin from a system that gives you a loans. The question is that how does the system ensure that you can't default? How do you ensure that if you run away, there's always a way to sort of recover the funds and recover the loan back? And the way some of these systems work is that they ask you to put a collateral. So you have to put a collateral, and against that collateral, you can borrow loans. But those collateral that you have to put is actually very high. So for example, for every, I mentioned this earlier, for every $100 worth of loan that you take, you have to put $500 worth of, in many cases, $500 worth of collateral. This is not very reasonable, because if you go today and buy, let's say, an apartment and a mortgage, it's not that high. The collateral is maximum. So the worst that can happen, let's say you buy an apartment and you take a loan for that apartment. In the worst case, what's going to happen is the bank is going to take your entire apartment, right? And they're probably going to auction it off and then recover their money. But beyond that, there's no other collateral. But here you have to put 5 times, sometimes even larger collateral, just to ensure that you can take a small loan. And that's not very reasonable. That's not very capital efficient. So the idea is to be able to build more capital efficient systems that do not require high ratio of collaterals. The last problem and challenge that I see today is when DeFi was designed, when DeFi was sort of created, one vision was that it's going to help people in emerging markets to use some of the systems and some of the financial services that they cannot use. For example, today, if you go to Indonesia, if you go to Bangladesh, it's very difficult for people to get a micro loan. In Europe or in America, it's let's say you start a small business. Let's say you're setting up a bakery shop. It's very easy for you to go and ask a bank to get you a loan, and the bank would do that gladly. It's very easy. But in remote countries, in remote villages in, let's say, Indonesia, it's very difficult for the bank to give you a loan. There's way too much paperwork, and the bank just don't want to bother. So the idea, one of the visions behind DeFi was to be able to serve those people who are underbanked, serve those people who are unbanked, and give them, make it easier for them to be able to access those services. That is literally right now very, very difficult to do so. Unfortunately, that has not quite happened. So this is this is a list of different DeFi protocols and systems, and it has a breakdown on how many. So the number of people who are actually using these services, and breakdown with respect to countries, and then try to understand how many people, what's the percentage of users that comes from emerging markets, what's the percentage of people that comes from developed markets. And if you look around, especially the red box, you'll see that the number of people actually using these services and coming from emerging and developing countries is very few. Around 4 to 5% is the average number that you see, which clearly kind of defeats the purpose of providing these services to people who don't have access to traditional services. So we need to figure out why this is happening. Why people is it just because people in Bangladesh or people in India don't know what DeFi is, or is it because it's very difficult for people to get involved in the DeFi? Is it because the user experience is very complicated? Is it because most of the capital that gets deployed in some of these systems always come from America or from Europe or from Western countries? So you have to understand some of these challenges and then build products and services that could cater to this specific audience. But yeah, this is currently not happening as the numbers suggest. Well, this is kind of the point where I would like to steer towards what we are doing to be able to improve and work with some of the problems that I mentioned earlier. So Zilliqa, as I mentioned earlier, Zilliqa is a blockchain platform similar to Ethereum. So we are a platform that allows people to build smart contracts, and therefore you'll be able to build all sorts of applications that you can imagine, including DeFi products. We are a company which is roughly valued at around $2 billion today in terms of coin market cap. The activity that's happening on DeFi activity, in principle, that's happening on Zilliqa blockchain is around $1 billion worth of activity. It includes, for example, staking, includes decentralized exchanges, it includes all sorts of things. And to give you a sense of how active the system is, every single second, roughly speaking, around $400 worth of assets gets traded or gets used or gets captured using that platform. Again, it's not Visa-like, obviously we are very, very far from that, but it definitely shows that the system is actually being used by people in the community. So we started by, as researchers from NUS, and the idea was to be able to build a system that would allow people to build scalable applications and be able to use that without worrying too much about the underlying limitations of capacity that the network can process in terms of transactions. Well, when we started, why we wanted people to build one, because we wanted to make sure that the system remains scalable. So I'm going to talk about very quickly the slide on scalability. So the number of transactions that Ethereum can process today is around 15 to 20 transactions per second, while Zilliqa, when we started to design it, it was when we tested the system, we were able to see that it can process up to 2,000 transactions per second. Again, it's very far from, let's say, or it's still sort of far from, let's say, reaching 1 million transactions per second, which I think at this point of time it's very difficult, given that decentralized systems essentially have certain bottlenecks. But it definitely improves upon some of the existing infrastructure that you see today, especially Ethereum. The other point that and again, one consequence of scalability is around transaction fees. So I talked about earlier that you don't want people to send a transaction worth $20 and pay $25 for as fees. So once the system becomes scalable, it becomes natural that the transaction fees will go down, because the system can obviously accommodate more transactions without having any impact on the underlying volume and underlying capacity. And the third part is about designing a smart contract language that is going to be safe for people to put their money in. So the way, for example, the language, the smart contract language for Ethereum was designed, it was designed from a very usability perspective. So they wanted to make sure that you can literally build anything that you wanted to using that language. Unfortunately, what ended up happening was people were able to make mistakes. People were allowed to make mistakes. And it came at a point where it was very difficult to understand whether a certain contract is actually safe to use or not. So the idea that we felt would be right was to build a language that would prevent certain things at the expense of making the system more secure. So you'd have developers and users will have a peace of mind when they actually go and use some of those contracts. So a very quick slide. I don't want to go into details of it. A very quick slide on what we do. So basically, the idea behind the way the Zilliqa blockchain scales is this sort of idea of divide and conquer. So in Ethereum and Bitcoin world, when you send a transaction today, this transaction basically gets processed by a lot of nodes in the network, and that is very secure, very decentralized, but it's also very redundant. So the idea was to be able to not ask the entire network to process the transaction, but divide that network into smaller groups, which we call shards, so that each shard can only process a subset of transactions. So for example, my transactions will go to, let's say, shard number 1, so the group number 1, and let's say Vincent or Damien's transaction will go to shard number 2. So to make sure that your transaction capacity basically gets shared across the network. In terms of smart contracts, I mentioned this earlier as well, was the idea to be able to build a contract that sort of trades off expressiveness of the language for safety. So you want to make sure that the contracts remain safe, the contracts are allowed to hold assets in a safe way. And what ended up happening was we were able to build this language called Scylla, which is formal verification friendly. So it's not just that it keeps your code safe, it keeps your funds safe, but at the same time, you have the possibility to write mathematical proofs that the contract is actually safe. So you could, for example, prove that your contract is not going to leak funds to another unintended user. Your contract is not going to lock funds for any user. These properties, you can define them as specification, and you can actually prove that those properties are valid and true. And there's something that can happen when it becomes much easier to do. I'm not saying that it's impossible to do in Solidity, but it's very, very complicated to do on Ethereum. But because you have restricted some aspects of the language, it becomes much easier for people to prove those properties, which is rather difficult to do so in Ethereum. Well, basically, that's it. Thank you very much for your attention, and I'm happy to take any questions if you have any.
Perfect. Thank you very much, Amrit. So questions, you can unmute or write it in the chat, how you prefer.
Yeah, if I may already maybe ask one question. I thought about the proof of work with Zilliqa, and I just wanted to know if the team today from Zilliqa, they thought about that on the long term, like maybe on the 5-10 years from here. Do you still want to work with proof of work? Did you already maybe thought like maybe a proof of concept like proof of stacking, maybe something even else?
Yeah,
And
so Yes, so the one difference that I would like to highlight is that in Zilliqa, the proof of work is used in a very different way compared to Bitcoin and Ethereum. So for example, today, let's say if you are using Bitcoin or Ethereum, for every single block that gets mined, you have a proof of work is associated with it. So a proof of work basically is used to mine every single block. While in Zilliqa, we don't do that. So so proof of work is basically used as an entry ticket. So what happens is every hour or two, the nodes in the network will do a proof of work. And if they are able to prove that they have certain, hashing power, and they are not Sybil at nodes, they get an entry ticket in the network. And once they have entered into the network, they process transactions, they validate transactions not using proof of work anymore. So they don't validate blocks using proof of work anymore. They use a classical BFT protocol. So basically about voting. So they vote on whether this transaction is valid, and if it's valid, they sign the transaction, and then once enough signatures are obtained, then the transaction is considered to be valid and secure. The good thing about this model is that you only use proof of work every 2 minutes, every 2 hours. That's it. So I'm sorry, not every 2 minutes, every hour for 2 minutes. So that's very short compared to something like Bitcoin and Ethereum model today, where you have proof of work is used for every single block. So of course the energy footprint is much lower. But I agree with you that we are also looking into ways in which we could even sort of start with. I mean, the reason we started with proof of work because it was sort of well tested, it was battle tested, so we had to go with something that we know works. And then slowly, the idea is to be able to mix proof of work with something else as well. So, for example, we could start with, let's say, 25% of proof of work nodes, and then there could be, let's say, 75% staking nodes, and then eventually sort of transition towards staking, over a period of time. But yes, we have intentions to slowly move away from proof of work as we move along.
Okay, if I just wanted to tell something above that question. Did Zilliqa until today had maybe like kind of attacks on the network or something with this kind of proof of concept, or did not today?
So proof of work. The good thing is that we have, of course, you can imagine people who can come up with a huge, powerful systems and be able to spin multiple nodes. It's possible. I'm not saying that it's not possible in theory. It's definitely possible in theory. But in practice, so far, we have not seen any attacks happen from proof of work angle. But yeah, I agree with you that we have seen in the past, even I think recently, Ethereum Classic was recently attacked, I think a couple of times using proof of work attacks. So that's happened in proof of work systems, but it has not happened on Zilliqa as of yet.
Thank you very much.
Just to mention, the top 3 questions will get a prize at the end. So feel free to ask your questions. And if you are a little bit shy, you can also just write your question in the chat, and then we will just read it for you, and Amrit will answer to the questions.
Yeah, you don't have to be shy. Just ask questions. It's fine.
I have one more, but maybe I will just first let the other people as well. Okay. Also.
I have a question. Okay, I will let
you go before me.
No,
I'm shy.
So my question is, how do you value the blockchain technology within this cryptocurrency ecosystem? Because you have way other projects that have less products than Zilliqa, and they're valued way more than the current value of Zilliqa. So the market cap, I'm talking about market caps.
Yeah, so obviously, this market is still very speculative, to be honest and fair to this space, which is in a way good and bad. Good in the sense that at least people are involved, not necessarily from a use. And this is exactly what I was mentioning, right? You have 143 million addresses in Ethereum, but if you look at the number of people actually using any of the dApps, it's quite very few, so probably less than 1%. So it gives you a sense of blockchain it's still in its very infancy. People are still using blockchains or holding some of these assets, not because they would like to use some of these assets, but because they just feel that if I just hold them, it's quite likely that my token value will appreciate over time, and then I'll be able to make money. But yeah, hopefully the whole system will mature, the whole ecosystem will mature at a point where people would like to use, because in the end, all these tokens that are being built or that are being sold around, they're in the end are utility tokens. They're supposed to provide utility to people. The good thing is that some projects obviously are providing utility. For example, Ethereum, and many other projects out there. Cosmos, for example, is building a good suite of products and services that people are actually using. I could give you example. I know I had my slides on Zilliqa as well. So if you look at, so we recently launched a DEX, a decentralized exchange on top of Zilliqa, and the number of users who are actually using that DEX is quite high compared to many popular Ethereum-based DEXs. So we have a community of people there are a lot of people actually who are sitting outside of Ethereum who actually want to use these services, but they are not able to use this for whatever reasons. So it's also a project's responsibility in some way to not just hype their projects from price point of view, but also give people access to those products and services. So in a way, again, we have to also to be responsible to lead the project and lead the system, lead the whole space in the direction where we want the project to go, and not just from a speculative point of view. So yeah, obviously there are projects who are probably ranked above us, but I'm not too worried about that, at least in the short term. We have seen projects who were ranked number 20 when we were at 20, and then we're at 90, and today we have basically swapped positions. So again, market cycles we can't control, but what we can definitely control is building products that people would like to use and people will use, and eventually the tables will turn.
Thank you.
Yeah, I also have a question. I'm not sure if it's in the level of my understanding of blockchain technologies. So maybe it's a stupid question, and in that case, I'm sorry. But you talked before about the artificial value attributed to cryptocurrencies, for example, that are coupled with, for example, gold. So basically, if I understood it correctly, it evolves together with the value of gold, right?
Yes.
Okay. But then how do you ensure that the principle of borders, of being borderless, stays true? Because it really depends on the object, which in question.
Yeah, so the way it works as a system is, let's say, for example, so there are two ways of doing it. One is, let's say you have gold, and for whatever reasons, I don't like going to a big, gold vendor and buy let's say a slab of gold. So what I would like to do is I would like to get exposure to that asset, okay, or that commodity in this case. So the two ways of doing it. One is you could go the way where you have custodians of gold who, what they do is they store gold and they issue tokenized gold. And basically, when the tokenized gold gets transferred, let's say I own that tokenized gold, and if I share it to you, then basically the underlying asset, which is the gold, physical gold, also moves under your name. Again, if you want to move it to your house, they can actually ship it to you. Okay, but in the end, you're only holding the tokenized asset. Okay, but yeah, there's a physical asset behind the scenes that you can always own. That again, in that model, there's still a lot of KYC, that gets involved. But that's one model in which you can get access to sort of a tokenized asset backed by a physical asset. The other model is, which I mentioned, about synthetic asset. This is something that exists in the traditional world as well, where the idea is there's no physical backing at all. So what you're basically doing is you are creating tokens which basically tracks the price of gold in the open market. So you look at the open market and the trading places, and if the price of gold is $100, let's say, then the price of this asset would be $100. And it gets updated, let's say, every minute or every 5 seconds, whatever, you can fix the parameter. So what you're basically doing is you're trading that synthetic assets. It doesn't, so if you hold that asset, it doesn't give you access to actual gold. You only are getting access to the trading element of that. That's it. But it does give you access to exposure to, let's call it, it's exposure to that volatile asset in some sense. That's it.
Okay, appreciate it.
And it applies to all sorts of things. For example, let's say if you want to buy Tesla stocks, right? But you don't want to go and do with your broker, and you don't want to do all that paperwork, but you just want to be able to make money through Tesla, let's say. So what you could do is these Tesla stocks, so you will have this sort of synthetic asset that tracks the price of Tesla stock in the open market. And then you buy these synthetic assets, and then once the price goes up, you sell that to other user who wants to buy that synthetic asset. So you're getting the exposure, but you're not actually buying and holding any Tesla stock whatsoever.
Yeah, and how does it work then with commodities that have a different value depending on the region?
Yeah, so again, they will have to structure that based on different user base. So for example, right now, most of the synthetic assets, that are being traded right now are mostly for US customers. So they actually track US market.
Okay, thank you.
I would have a question if that's okay.
Sure.
I just came out of a marketing class from the university just before, and I was wondering how do you market the project in the blockchain world? Do you have to come up with new ideas of how to do it, because it's quite complicated, it's quite new, people don't necessarily understand the implications? So I was just wondering, how do you get the word out there?
It's quite complicated to be honest. But the good thing about marketing in the blockchain world is that the moment you launch your company, unlike many other traditional companies and startups, the moment you launch your company, but I was talking about this borderless nature and the globalness of assets. The moment you launch a company, it immediately becomes a global company. So whether you are, launching a company in India, whether you're launching a blockchain company in Nigeria, it doesn't matter. If you're launching a token, because of the fact that this token becomes tradable across, by anyone outside of that country, it automatically becomes global in that nature. So in that sense, your marketing approach can never be local. In that sense, it has to be global in nature, because you have consumers, you have people holding your assets, you are sitting in another continent, and you want to cater to their demands and you want to cater to their needs. That's one aspect to when you're actually starting. The second biggest thing that you have to worry about is about building a community, because all these assets, all these blockchain platforms have different communities that you have to use. Because, for example, if you are building, let's say, Bitcoin has a value because people believe in it, right? People give a value to it. You could always say that here's my napkin, and this napkin has, I don't know, is valued to $5. People would do that if someone else wants to buy it for $5. So there has to be a sense of community, and you have to put a lot of effort into community building. And community is needed, one, because you want people to hold your assets. You want people to use your systems using those tokens. Number two is you want people to maintain that system. For example, in case of miners we were talking about earlier, right? Someone needs to mine that system. Someone needs to maintain that entire decentralized infrastructure. So you need to market to miners as well. You need to make sure that there are enough people who are able to sort of support your network. And then you need basically people who want to develop on top of your application. So whether you are a platform provider, so it's like Windows. So when you launch a Windows system, you want people to build Facebook-like applications. You want people to build a Google-like application on top of your platform. So you need to market to potential developers to build those products on your platform. So basically, these are kind of 3 or 4 sort of areas that you have to focus from marketing angle. And in the end, it's all about building product that people would use. There are obviously some people call it ghost chains. So that chains which are live running, but no one is using them, because either the community is not there, or because even though the community is there, they're not interested in using any of the applications that you're building, because they're only interested in hoping that the price of the underlying token will go up, which is not a good model. So you also have to sort of nurture your community and sort of educate your community to go in a direction which you want them to go. And that's also a part of marketing in some sense.
Thank you.
I would actually have another question.
Go ahead.
How do you think in the future the volatility aspect in blockchain in general and from Zilliqa will actually develop? Because as you have said, in order that people actually start using it and stop just only speculating and holding it, is there a plan, or what is your prediction on that one?
Yeah, so to answer this question, I would say that the blockchain world will always have a speculative element to it. We can't get rid of that. It's impossible. But at the same time, we'll also have stable coins. Today, literally, if you go today and look at all the assets that are available on CoinMarketCap, if there's one let's call it one asset that has really seen real product market fit, so people actually using it for its actual use case, it's USDT, which is the stable coin. And the reason why people use it is because they want to get out of volatility. So let's say you hold Bitcoin, and for whatever reason, the price of Bitcoin is going down, and you want to sort of get out of the volatility, you trade that for USDT, or you trade that for USDC. And once the volatility is sort of settled, you come back. So that's one clear use case for stablecoins. Again, these stablecoins are not currently used for payments, obviously for regulatory reasons and so on. But maybe one day, given that many governments today are actually interested in looking into stablecoins, there will be a point where everything will become digital. So now you won't have to use your fiat at all, and you'll be able to actually use tokenized fiat in some day. But this speculative element is not going to go away. But having said that, there are products and services being built that use a volatile asset. For example, I mentioned about the stablecoin, right? So stablecoin, this whole stablecoin system works. And the stablecoin which is not backed by fiat, it works because of a volatile asset. So because there's a volatility, you are actually able to build a stablecoin that sort of leverages on the volatility directly. So you also need a little bit of uncertainty, a little bit of volatility in the market. Otherwise, you won't be able to build products. So it's not going to go away. But yes, the use cases for stablecoins will definitely going to grow. Today, for example, if you have, let's say, fiat in your bank account, in many countries in Europe, I hope maybe you're probably earning, I don't know, less than 1% of interest rate. In some countries, you even have to pay. There's a negative interest rate, so you even have to pay to be able to bank to be able to hold that asset in their accounts. While in stablecoins today, what you can literally do is you can take your fiat, you can convert them into a crypto fiat, so a stablecoin. And these stablecoin is huge in demand today in markets because people would like to buy stablecoins and then buy Bitcoin or buy other volatile assets because they want to get exposure in that volatile asset. So there's actually a lending market, a huge lending market around stablecoins. And the stablecoin, for example, if you go to decentralized marketplaces today, the stablecoin lending rate for stablecoin is around 10%. So you literally can take your fiat, convert to stablecoin, lend them to other traders and market makers and institutions, and around 10% interest rate. So you also need that volatility, because if you kill that volatility from the market, the whole system will sort of, you lose all the benefits of what's going on. And this is exactly why investment banks and all these hedge funds work, right? They exist because there's the volatility in the market. So that's not going to go away.
Very interesting. Thank you.
I just have a question about stable coins, because you talked about the contracts between a stable coin holder and a speculator. And you also talked about Tether, which is USDT. But if I'm not wrong, I think USDT, it's pegged to dollars, and they are modifying the supply depending on the demand. And my question is, do you have a limited supply when you have a stable coin on the Zilliqa blockchain, or is it not limited in terms of tokens?
Yeah, so the way stable coins like USDT and USDC work is that basically you as a user, you take your fiat, so you take your cash and go to USDT, let's say the company behind USDT, and say, here's my fiat, take my fiat and give me a stable coin token, and they give you. And so you use the stable coin, you do whatever you want, and let's say you want to get your fiat back. So you bring your stable coin, you give them back to the issuer, and this issuer will give you back your fiat, modulo some fees, let's say. So in simple, this is how the stable coin backed by fiat, they work in this way. The way, so there's no limitation to it, literally. And again, maybe one regulatory element is that regulators would like to impose is that people issuing stable coins, they must have the reserve to back those stable coins. So if there are, let's say, 1 million stable coins in the market, there must be $1 million in the bank account somewhere. So this is what regulators generally want. In some cases, some of the stable coins cannot satisfy this. In some cases, they do. But yeah, that's a regulatory question that we have to, that's a completely different thing. But yeah, this is basically how it works. So there's no limitation in general on how many stable coins can exist in the market. The same for stable coins that are backed by volatile assets. So as long as people can put more and more collateral, you can always mint, they're allowed to mint more and more stable coins. There's always, again, it's very algorithmic. So put more collateral, mint more stable coins. And what ends up happening in many cases is when the collateral values sort of goes up. So let's say, for example, you're putting ETH as a collateral. So basically the collateral works in the following way. So if you are, let's say, they work in the dollar value in some sense. So let's say, if you're putting a volatile asset that has, let's say, currently valued at $1, you're able to, let's say, take or mint 50 cents of a stable coin. Now, for whatever reason, let's say the price of the volatile asset went up, let's say doubled, then you actually can borrow more, because in the dollar value, you only have to guarantee a certain ratio in dollar value. Now, because the volatile asset has gone up, you can actually mint even more without even putting more collateral. So many people actually take benefit of this situation when the price of, let's say, Ether goes up, people would like to actually mint more stable coins because they think that they can actually mint more stable coins. And when the price of, let's say, volatile asset goes down, what they do is they buy the underlying asset as a cheaper rate because the price has gone down, and they basically top up their collateral. So this way, they sort of try to maximize how much they can leverage from that position. So yeah, there's no limitation. So short answer is there's no limitation on how much you can mint.
Thank you. And so right now you have the Singaporean dollar, which is on the Zilliqa blockchain. Are you planning to have other stable coins and other digital currencies?
Yeah, so we are, as you said, we have a Singapore dollar-backed stable coin that works like USDT and USDC. So it's a fiat-backed stable coin. The company behind XSGD, which is a company called XFIRS, which is regulated by MAS, which is the local regulatory body in Singapore, they also are interested in building an IDR-backed stablecoin, so Indonesian rupiah-backed stablecoin. So we definitely have intentions to actually issue more stablecoins backed by fiat. Obviously, and in fact, the good news is that if you look today, all the stablecoins that have been issued today, so fiat-backed stablecoin, obviously the largest one which is issued today is USD-backed stablecoin. I don't exactly remember the number, but it's obviously in billions, tens of billions of worth of USD has been tokenized. The second one is euros for obvious reasons, because it's one of the second largest market. And the third is actually Singapore dollars. So XFIRS has been successful in making Singapore dollars the third largest, even though the Singapore market is quite small. It's a very tiny country. The number of Singapore dollars is actually quite high in terms of, if you look at the tokenized market. So the intention is obviously to bring other stable coins like IDR. We also are looking into bringing USD-backed stable coins. So through two means. One is by directly asking USD stablecoin issuers to build natively issued stablecoins on top of Zilliqa. At the same time, we are planning to build a bridge between Zilliqa and Ethereum. So what's going to happen with this bridge is that you can take your, let's say, USDT or USDC, which is sitting on Ethereum, and you can basically transport them on top of Zilliqa as if it was sitting on Zilliqa. So that's something that we also are working on. Maybe in a month's time, we would be able to issue that and have that system in production. So that would also be possible. And we also have a stable coin backed by volatile assets that's coming up called Pillar. So very similar to MakerDAO, where you would be able to put Zilla's collateral, and then you'd be able to mint Pillar, which will be a stable coin softly pegged to USD. And then you'd be able to use that as if it was a stable coin.
Thank you. You talk a lot about different projects that you have within the blockchain of Zilliqa. How many projects do you have that are already built and running on the blockchain?
So we have so far, through different mechanisms, we have sort of seeded and given grants to around 60 projects from 20 countries to build on top of Zilliqa. Some of the notable ones that have been really, really successful was, for example, a domain name system called Unstoppable Domain. So when you look at google.com and so on, so when you visit a website, these are actually backed by DNS servers. And so what the idea was to be able to build a DNS server, DNS system that will be backed by blockchains. So there is a company called Unstoppable Domains, which was later backed by Team Draper. They have built a domain name system on top of Zilliqa. The other very successful project has been the DEX, and automated market maker, basically a decentralized exchange, which allows people to issue tokens and provide a marketplace for people to trade those tokens. Another example, we talked about this a minute ago about XFIRS. So there's a tokenized sort of stable coin that's out there. We have people building systems that issue tokens. So, for example, gaming applications that require tokens. There are people building a prediction market that requires a token. So there are a lot of token projects that are coming up. There's a project where people are building what I like to call it a human stock market of some sort, where, let's say, imagine, for example, you are a user and you feel that, you are a capable person, let's say, and you feel that if someone invested $100 in you, you could return back $200 because you would write a book, or you would write a music, you would do something interesting that would make you money, and then you'd be able to give back money to your investor. So instead of thinking about setting up an entity, a company, and asking people to invest in that company, you'd say, just invest in me personally. So invest in me as a user, and when I make money, for every $1 that I make, you will get 2 cents or 20 cents from that money that I make. So people are working into, especially, people are sort of restructuring and designing systems especially around YouTubers. So YouTubers actually make a lot of money, by the way. So the idea is to be able to, for them to provide access to investors and say, look, I will invest in me, invest in my resources, and then if I make money, you will take a cut. So there are systems being designed around that as well. So again, this is just not an exhaustive list, but yeah, a lot of projects around that are being built around the Zilliqa blockchain, and more to come in the future.
Thank you.
Maybe a bit of a less technical question.
Sure.
Did you feel that the whole GameStop incident and these things have an influence on the mainstream demand for blockchain? So kind of this demand for something that is borderless and cannot really be influenced?
It does, I would say. If you think about how Bitcoin sort of started, and if you look at the genesis block of Bitcoin, it was basically inspired, and the Satoshi Nakamoto, who actually designed the whole system, he basically wrote a text and reference to the fact that there was economic sort of decision made by the governments, which was not good. So definitely some of these very impactful decisions and very impactful projects come out because of what people see in the world. And people, for example, in the Reddit case and GME case, they really literally realize that it's, sometimes the traditional market players, they actually have an upper hand because the system is very opaque. They can, strike deals and, insider deals with different parties, and it becomes very difficult for actual end users, retailers, to actually get access to those services because there are certain insiders who have better access and better leverage. Other examples that people are really frustrated today, especially retail crowd, is about why people who, why certain companies, when you invest in some of those companies, like for example, pre-IPO companies, you need to have accredited investors sort of status to be able to invest in those companies. And what ends up happening is basically makes people richer and richer, right? So so basically the requirement is that if you want to invest in certain companies, you have to be accredited investors, so you have to be a high net worth individuals. And when you invest, then you are actually going to make more money, because after that you're going to dump, or sell those assets to retail investors. So in a way, the system is designed in a way to, let's call it, protect people. In the end, in a way, it's basically leverages a retail crowd. And that's exactly why many people are actually building systems that can sort of change the whole dynamics in the other way. So I would say yes, many of these incidents that you see today are going to impact the way people build products and people build services, and then people are going to use some of these services in a different way. And it's actually happening. 5 years ago, banks were very banks in the sense that they're very classical, they're very old structured methods and ways. Today, banks are changing. You have banks like Revolut today, which have technically become a software. So bank is no more a physical entity, but it's a software. And these softwares now even are opening to the demands of consumers. So now these banks are actually allowing people to buy Bitcoin. They are allowing people to buy Ethereum directly through those infrastructures. So you have on one end traditional financial infrastructures like banks and investment banks and so on. And then you have DeFi products and services builders. And they are, in a way, they're getting closer and closer because banks are giving people access to crypto assets. At the same time, DeFi products and services, they also, in a way, sometimes they think that it'd be probably good if we can regulate some of these infrastructures. So they're also trying to apply for a license as well. So at some point, they will come closer and closer at some point. And I definitely believe, my short answer is I definitely believe that many of the systems that are being developed, they are backed and inspired by some of the incidents that you see in the real world.
Thank you.
Okay, perfect. Thank you very much. So we have already taken 15 minutes more of your time, Amrit. So if you still have time, we'll maybe take a last question.
Sure.
Otherwise, we would start to wrap it up here. So last call.
I still have one question if I can.
Go ahead.
Just with a couple of numbers, because most of the numbers, sometimes you have a good vision on the long term as well. We already talked a lot about the stable coins, but with the speculator, you showed when we put both $100 in a contract, if the token gets like minus 50%, at that moment, the speculator will lose his money.
Yes.
Do you already have some numbers, like in a return on investment on the year for the speculator? And did you also thought about the pump and dumps on the market, who will then wreck all those contracts?
Yeah, so the example that I showed you, it was more of a thought experiment. So it's not something that has been already deployed in the system today. So it was just an experiment to sort of thought experiment to explain to you how a simple system can be designed. Obviously, there are more complexity. You can't build a system like that. You know, it's more like a textbook sort of example, I would say. But for example, MakerDAO is an actual system which leverages some of the ideas that was in that example. So yes, there are all sorts of clauses built in. For example, the moment the price goes down below a certain value, everything could get liquidated. There could be examples where, I think it was in March last year, I think, when the ETH price literally dropped down heavily. And because of that, a lot of people actually lost their money because their positions got liquidated. So there are certain very catastrophic events that can potentially happen, and the system has to be built to cater to those incidents and events. So yes, the system in the end obviously becomes more complicated. But yeah, the example that I showed you was a more of a textbook example to give you an idea of how to build such a system. It was not a real tangible example that's in production today.
I see. Okay, thank you very much.
Perfect. Okay, thank you very much, Amrit.
Thank you very much. Thank you very much for inviting over. It was lovely interacting with everyone here.